So we are looking at the audit approach, chapter 6, page 170. Page 170. Now, you will agree with me that when an auditor wants to start an audit, he will have an overall audit plan that he wants to use to carry out that audit plan. That means the auditor is going to have an audit strategy, and that audit strategy is the approach that the auditor wants to use to carry out the audit now. Am I communicating now? And that will now take us to possible audit strategy that an auditor can decide to use for his audits, for the audit assignment. So we have 4 audit strategies that the auditor can decide to use for the audit. And this audit strategy will enable the auditor to will look at which strategy is suitable. That means all these 4 strategies cannot be used for an organization. It means that the auditor will look at the strategy that is suitable for the organization he wants to audit. That means this strategy, this possible audit strategy we are looking at, which is 4, cannot be used in some circumstances now. Now, let's look at the possible audit strategy that the auditor will use to carry out his audit now, the audit assignment that he wants to perform. And this, don't forget, this audit strategy will enable the auditor to gather the sufficient and appropriate audit evidence and will enable him to form an opinion. Now, let's look at this now. We have 4 audit strategies, possible audit strategies that the auditors can choose from. We have business risk strategy. We have business risk approach, and it can also be called risk-based approach. This is called business risk approach, or it can be called risk-based approach. And another name that we can call the business risk approach is also it can also be called top-down approach. It can also be called top-down approach. Is that they call it business risk approach or risk-based approach or top-down approach. We also have what called system-based approach. System-based and substantive testing approach. We have substantive testing approach and we have statement of financial position approach. Now, these are the 4 possible audit strategies that the auditor can choose for his audit strategy. We'll be looking at each of these strategies one after the other. But however, let's look at the factors that the auditor must consider before he can choose the appropriate audit strategy. That means the auditor must look at some certain factors that will make him to choose between these 4 possible audit approaches. We have to choose which one is appropriate now. So let's look at the factors now. One of the factors that an auditor can use to choose which audit strategy is appropriate for the auditor, the nature and the size of the client's business. That means if the nature of the client business is large, that means we are saying that the best approach to use for the audit strategy that will enable him to carry out his audit will be business risk approach. So when the company is large and perform in large transactions, now there are big companies like Dangote now. That means the best approach that you can use is the best suitable approach you can use is business risk approach, or you call it risk-based approach or top-down approach. Now that is the most suitable for large companies. But for small companies now, don't forget we are looking at the nature and the size. The nature and the size of client business. So the nature can be large and the nature can be small. So if the nature is small, it will be statement of financial position approach that will be appropriate to small companies. That means when an auditor wants to carry out an engagement for small companies, the best approach to use is statement of financial position approach. Don't worry, we are still going to look at each one of these now. Now, when in a company where there is control procedures or control environment, meaning that there is effective internal control system or mechanism in place, the best approach to use will be the system-based approach. The system-based approach is the best approach to use when a client have effective internal control system in place. So the best approach to use is system-based approach. Am I communicating? Now, when there is no strong, don't forget when you have effective internal control system now. I've told us that when you have the effective internal control system, that means the internal control system in place is strong. I told us that it is system-based approach we should use. But in a case where the internal control is weak, which approach would be the best for you to carry out? It will be substantive testing approach. So substantive testing approach is used when the internal control system is weak. Now, I've told us that statement of financial position approach is the best approach to use when an organization is a small organization. Now, the reason why I'm explaining this for us is that you may be given a question in the exam. You may be given a question in the exam and you may be asked to select the approach, the strategy, the audit strategy, the possible audit strategy for that scenario. And you may be asked to justify the reason why you are using that audit strategy. So you need to give reasons why you are using it and explain the reasons or why you can choose either of these approach. However, all this approach that we have made mention may be used in combination. Am I communicating now? All this approach, that is, you may choose one or two approach and use it together. So it is not that if you choose one, you may not use the other. If the two is appropriate, or if there is a way where you can use the two together, you can combine the two approach or one or two approach together now. So let's go to the first approach now, which is business risk approach. And I've told us that business risk approach can be referred to as risk-based approach or top-down approach now. That's what we want to look at now. So we want to look at the meaning of business risk approach. We want to look at the meaning of business risk approach, or we call it risk-based approach or top-down approach now. So we want to look at the meaning or the nature of this approach now. That means this approach, when auditors are using this approach now, the auditor will need to concentrate. Am I communicating now? The auditor will need to concentrate on the area of the business, that have high business risk. That means the audit will focus on the business risk. That is on the business risk, on the area of the business risk in that organization or that organization is facing. So they will concentrate on that aspect business risk approach or risk-based approach now. So I will just read some out. In a risk-based approach, the auditor will concentrate more of the audit work on the area of high over audit risks now. Now, what do we mean by business risks? Because I've mentioned the word business risk. So what do we mean by business risk? Because you have to understand business risk before you can understand what business risk approach is now. Now, business risks are the threats. Am I communicating? Are the threats or they are events or development that are adverse to the organization that will prevent the organization from achieving their objective. That is what we call business risks. So business risks are those risks that will be adverse, unfavorable, or that will make the business not to achieve its objective now. So if the auditor can achieve or can identify the business risks now, am I communicating? He will now focus his audit. He will focus his audit on the high risk or on the high business risk that the organization is facing now. So it means that it is those areas that will begin to carry out his audit on, instead of looking at the whole financial statement. Because this business risk will enable the auditor to actually save time. Because don't forget, when you are auditing a company like that, it is impossible and it will take time. Don't let me say impossible, it will take time for you to test all the balance in the financial statement. Because look at inventory now, look at the revenue. The revenue comprises of different transactions, thousands of transactions. Will you be looking at the transaction from the card to the ledger, one after the other? It will take time. So you concentrate on the area of the business risk now. That means the auditor will focus his audit or concentrate on the business risk now. And his audit will now be based on the business risk. And what is the impact of the business risk on the financial statement? Let me give you an example now. An organization is having an issue in terms of finances. They need finance for them to widen their scope or their operational. They have approached the bank. They have approached different banks. Now they are finding it difficult to raise funds now. Do you know that in raising that inability or finding it difficult to raise that fund may cause business risk to them? Because if they are not able to get that fund, that means it may have an adverse effect on their objective. That means the objective which they have set for that period may not be achieved. What's the objective? For them to expand their business. Now, you know that risk, that business risk, that is not able to find finances or funds to fund their expansion may cause the management to manipulate the financial statement in a way that it will look fine to the banks that they want to approach. That can make them to present the financial statement wrongly. So if the auditor is able to identify that if they don't get that finances now, it will have an adverse effect, or the organization will not be able to achieve their objective. Once he will now look at the impact. What do you think the management can manipulate? What do you think that the management may present wrongly in the financial statement that can make him to provide or to produce a wrong opinion? Am I communicating? Now, let's look at the general approach that you can use when you are carrying out, when an an auditor is carrying out all business audit risks now, let's look at the approach. The number one approach for an auditor to use when using business approach is for the auditor to identify the key business risks. Am I communicating now? The auditor must identify the key business risks when you are using business risk approach or risk-based approach or top-down approach. I will explain the reason why we also call it top-down approach now. After identifying the key business risks that will not make the organization to achieve their objectives now, it will now look at evaluate the impact of that business risk on the financial statement. What is the impact of that risk on the financial statement? It will look at it. This is the approach that the auditor must use when carrying out this audit business risk approach now. Am I communicating now? He will now plan after he has looked at the positive impact. Now, I've told us now that a bank wants to borrow more funds. They want to borrow more money from the bank. There is a likelihood that if they are owing some banks before, or if they have a long-time liability like bank loan, they may actually want to reduce their bank loan in the non-current liability, and also reduce their finance cost so that the bank will look at the finance cost is relatively small. So the bank will look at this now and be like, okay, since if they were able to give them this fund, they will have the capacity to pay back the loan and also with the interest now. Are you getting it now? So the auditor will need to look at the impact of the business risks now to the financial statement. After the number two model, I told that we will identify the general approach to this business risk approach is for the auditor to identify the key business risks and evaluate the impact of the business risk to the financial statement or on the financial statement. Now, after you have evaluate the impact of the business risk on the financial statement, it will now plan the audit around the business risk. Now, it will now plan the audit. The audit will now be carried out around the business risk that he has identified. Am I communicating now? But the issue is that for an auditor to use business risk approach effectively, he must be able to the auditor must be able to have a clear understanding of the operation of the company. That means the auditor must understand the entity and its environment in which that entity operates. That means you must understand, because if you don't have a better understanding of the entity and its environment, you may find it difficult to identify the business risk. So the auditor must have a good understanding about that client and the environment in which that client operates. Because how can you know the risk, the business risk that I am exposed to, that an entity is exposed to, if you don't have a clear understanding of that environment or of that entity, the kind of operation they are carrying out, and the environment in which they operate now. So it is relevant that is why ISA 315, that's International Standard on Audit 315, which says identifying and assessing the risk of a material misstatement. And they said you can identify and assess the risk of material misstatement in the financial statement if you are able to have an understanding the environment in which that business you to identify the risk and assess the risk of material misstatement. Don't forget, I told us International Standard of Audit 315 is identifying and assessing risk of material misstatement. Am I communicating now? Now, I've told us that business risk approach or audit risk, business risk approach, or you call it risk-based approach, and it can also be called top-down approach. Top-down approach. Why do we call it top-down approach? Because we have been looking at why do we call it top-down approach? It is also called top-down approach. Why? It's because the approach starts at the top with the business. That kind of stuff. It started with the business, which generates the financial transaction. Is the business that generates the financial transaction. Now, it will now end with the bottom, the bottom. Why? Because the impact, because that financial transaction that was generated at the top of the business was actually recorded in the financial statement. And that's why we call it top-down approach. Now, I told us that the reason why we're calling it top-down approach is that the approach starts from at the top. It starts at the top with the business, because it's the entity that generates the transaction, the financial transaction. And bottom means that transaction will be recorded in the financial statement, and the outcome, that means with the financial statement, which record the outcome of the business transaction. That means it is the financial transaction. You can see now, it started with you identifying the business risk. And how do you identify the business risk? You concentrate on the entity. You concentrate on the business. That business on the entity that generates that transaction. By the time you have done that now, you now go and look at the impact of that transaction on the financial statement. That's the reason why we also call it top-down approach. Now, let's look at what we call the internal and external business risks. Because in your exam, they may give you a scenario and ask you to identify the business risk. So you must understand that business risk is not only external. Business risks, I told us that they are events or development that can cause an organization not to achieve their objective. So if the equipment of an organization and the key equipment they are using should break down, what happens? That means they won't be able to achieve their objective for that period now, because the revenue will drop. And if the revenue will drop, that means the profit maximization, because business, for every entity, the essence of coming into existence is for what? It's for profit maximization. So if the revenue will drop, what happens? That means they won't be able to achieve their objective. So business risk can either be what? Can be caused by internal or external, can be caused internally or externally. So we have to look at example of external business risks. What are the examples of external business risks now? One of the examples is possible loss of major contract. That means if there is a possible loss of major contract that they may lose this business, is a one of external business risk. Because if they lose a business with a customer now, if they lose a contract with a customer now, what will happen? That means they will lose the revenue on that contract now. And the objective of that business may not be achieved. Am I communicating now? Now, what about long-term decline in the demand for the business product? That is decline in the sales of the product of the organization. Am I communicating? So it can cause decrease in revenue. And if they cause decrease in revenue, what happens? the profit maximization of that organization will not be achieved. Now, what about introduction of new competitors into the business? It may actually cause business risk. So these are the things that the auditor must look at and look at the impact of these in the financial statement. Now, also what about introduction of new technology? It may actually cause an adverse what? If an adverse effect on the objectivity of an organization. Also, when there is change in regulation or laws. Now, maybe the law now prohibit that you should not use some certain substances now in your products. Am I communicating? And it's very important for you to be using those chemicals or products or those chemicals in your product and the law. So you may not likely want to continue the production of that product. So rule and regulation, sometimes the rules of the country can actually stop the production of some certain goods or services. Which may actually have effect. The laws too may state that you should provide some certain measures in place, and putting those measures in place will be very costly for the organization. And if it's costly for the organization, that means it will affect the organization. They won't be able to achieve their objective. What about the impact of natural hazard like flood? This year now in Nigeria, they predicted that some states, like 22 states, will actually face flood or storm. It may actually have an effect. Look at some businesses that are located in those areas now. It may affect their operation. And once it affects their operation, it will not, the company will find it difficult to achieve their objective Now, threat from competitors to the company patent or copyright. That means if the competitor can copy what you have produced, can replicate the same thing. So it will cause. So let's look at the internal now. What are the internal? Let's look at the internal business risks. One of the internal business risks will be ineffective employee. That means if the employee are inexperienced, they don't have the required capacity to perform their work. Just look at someone like the finance department now that does not understand the double entry principles, or that does not understand how to prepare financial statement, and is being recruited to be part of those that will be preparing the financial statement for that company. What will happen? That means there is risk. It will cause a business risk, and it will cause a business risk, and it will have an impact on the financial statement. What about weak management? The management does not have the adequate skills or expertise to actually perform their roles as or directors or as a management. What about risk of lack of customer care? Lack of customer care may cause the business not to achieve their objective, because the customer will be going to other competitors where their customer care is high, and this will increase the sales of the competitors and reduce your sales now. What about poor financial management? Poor financial management or cash management, or poor working capital management, it may cause business risk now. What about weak internal control system? Weak internal control system, where an organization relies solely on one individual for finances. Let's say Otolela is one of our major provider of funds now. If anything should happen to him now, what happened? The business will collapse. And that's what happened to the business of MK, late MK or Abiola, when he died. when he was there, the business tool that he has was actually collapsed too. So you have to look at that too. Now, also, what about appropriation of assets or risk of fraud? When there is possible what risk of fraud or misappropriation of assets. You know, assets that are supposed to be used for the production of goods and services is being used for another process, or is being used for another thing by the directors. So this may cause. Now, the reason why we are looking at this is that in your exam question, you may be expected to identify key business risks. Key business risks, whether internal or external, from the nature of the business and the facts given to you in the question. So you need to look at the question, the case study question that I'm giving you, and you should be able to identify the key business risks in the question. So it may be asked. So you will need to identify the business risks and explain the business risks based on the information that has been provided in the case study questions now. And you will also explain how the risk will have an impact on the company's ability to meet their objectives. And what impact will these risks have on the audits? So you need to look at it now. So based on what I've explained now, there is a question here. So it will be an assignment. So what you do is that you read through the questions, and because what they did, the answer they gave in this question bank, in this material, in page 178, is just to identify the business risk. So you go further by now, you will identify it. What are the business risks? Don't use word for word there. If you copy and you identify the business risks. So you will read through it. You will explain, you will identify the business risk and explain the business risks based on the information that has been provided, based on the information that has been given in this case study scenario. And you will now explain the impact of the risk on the company's ability to achieve their objective, and what impact will these risks have on the audit. Am I communicating? Evaluation now. Let's go to risk evaluation. Risk evaluation, that's the next thing we are going to. So we have looked at the meaning, we have looked at the meaning and the nature of audit or risk approach. We have looked at external and internal business approach. So we are looking at risk evaluation. No, when I was telling us the other time, I told us that the auditor will only concentrate on high business risk. It will concentrate on the high risk. So the auditor may actually identify different risks. It is the risks that are key, the key risks, the important one that the auditor would plan his audit around. Am I communicating now? So it is necessary for the auditor to carry out what we call risk evaluation. This risk evaluation will enable the auditor to identify the key risks that he will need to plan his audit around. And how will the auditor value, or how will the auditor evaluate this risk now? That means the auditor will evaluate this risk using two factors. It will use two factors to evaluate this risk. Now, it will use the probability of the risk occurring. That means the likelihood that the risk will occur. So it will look at the risk. It will focus on what they call the likelihood or probability that the risk will occur, and if you concentrate on the impact on the risk, that means the risk that has the highest impact, that has the high impact and high level of occurring, that's the risk it will what it will focus on. Am I communicating? I'm in page 180. 180. Now, will you agree with me that it is not all risks that the organization are exposed to that are significant, or that are important, or that are key? That means the auditor cannot focus or surround his audit with all the identified business risks. It will only focus on the risks that have an high impact, that will have an high impact on the financial statement, and there is a probability that that risk will occur. There is high probability that that risk will occur. That is where the auditor will focus his audit on. That means, look at now. If you go to page 180 now, you see now we have category 1, category 2, category 3, category 4 now. Now that means the auditor, we need to group his risk that he has identified. It is the one that is in category 4, category 1 that the auditor will focus more on, because more emphasis will be based on category 1. And why will more emphasis be placed on category 1? Why? Because it will focus on risk that has an high impact and an high likelihood or probability of occurring. Am I communicating? That is where the auditor. So let's look at we have looked at risk evaluation. So let's go to advantage and disadvantage of business risk approach. What is the advantage and disadvantage of business risk approach? We have to look at it. But sometimes in your exam, especially I've seen, is it joint audit or group audit? I've seen in the past question where they have the advantage and disadvantage also. I think there was a time when I was writing the audit, the time I was advanced audit, when I was writing my kind, and I think a question like that actually came out. They even asked you that I should define, I can't remember, maybe it's joint audit or group audit. So you may be asked to also provide the advantage of and disadvantage of the approach. So you may be given case study scenario and you may be asked to what that okay, the approach that you have selected, and I've told us the reason why you can select each of the audit strategy have informed us. Now you can say after you have chosen the suitable strategy now, you can ask that you should provide advantage and disadvantage of the audit strategy you have chose for the audit now, or you have chosen for the audit. So let's look at advantage and disadvantage of business audit approach. Now, one of the advantages which I don't normally forget is that it will enable the auditor to have an in-depth understanding of the client business. It will enable the auditor to have that, because that approach insists that when you are using that approach, you should have an understanding of the entity and its environment which it operates. So it's required for you to have an understanding of the entity. So the auditor will have an in-depth knowledge of the client's business. Now, the auditor too will be up to date about the things that are happening in that client's business. It will have an up-to-date information, because when you are auditing an organization that is operating in an environment that is rapidly changing, that is changing, and what what they have done in 1 week's time may not be what they will do again in 1 week. Maybe they are changing, especially in telecommunication companies or in companies where or sectors or industry where things change rapidly. That is the auditor we have an in-depth, we have an up-to-date knowledge, or we have an up-to-date knowledge because this approach requires the auditors to have an understanding of the operation and of their entity and also the environment in which it operates. Now, thing is that major audit problems are more likely to result from the business related problem. Can you see? Now, this approach is saying that major audit problem comes from business related problem. Because if the business is having issues, what will happen? It will have an impact on the business. Instead of you focusing on the internal control system or internal control weaknesses, they say the internal control system is weak. Rather, the problem they are facing in the audit will normally result from the business related problem. Just imagine now that we have said now that the management are weak. What will happen? The management wants to continue to manage that business and want to manage that business even though they don't have the skills and capacity now. So there may be something that they will be doing that will having financial effect on the financial system. Because if the management are strong, they will keep what? They will keep relevant attention to the internal control system. So because they are the one that will ensure that there is internal control system in place. So this business will enable you to what? Will enable you to will suggest the major audit problem to you. The major audit problem that is caused majorly by the business related problem. Now also this approach enable the auditor to also add value, because if the auditor has actually gained understanding of the business and the environment in which the business operates, that means there may be some things that the auditor will be able to identify and how they can solve it. So he can suggest to the business, I've done and I've discovered that you guys are exposed to these business risks, but however, you can do things like this, do it like this, do it like this, to make it to actually reduce this risk now. Can you see now? The auditor is even suggesting because of this approach now. So the auditor is adding value to the client through what? Recommendation to the client. So now also the audit cost, the cost that the auditor will include or will incur in this approach will be what? Will be reduced, because the auditor is not testing all the balances in the financial statement. He will just look for the high business risk and what plan his audit around those business risks now. That means those are the aspects or area in which he will audit now. So audit costs will be reduced by this approach. Am I communicating now? Now, the auditor can also benefit from this approach now for their own business, because once you are able to identify the business risk through the understanding and through understanding the business environment, it will make the auditor, because all these firms, they don't only carry out audits. They also those things they have identified, they can also use it for their own operation also. Am I communicating? He said the approach may benefit the auditor own business because it uses a modern business risk approach, may differentiate the firm audit services from that of the competitor. Because when you are using business risk approach, they are saying that you have to have up to date. That means that this approach enable you to have, and we enable the auditor to have an up to date information about the business, especially in rapid changing environment, in rapidly changing environment. So that there will be some auditors or some audit firms that they may not adjust, or if they are not using this approach, it will be very difficult for them to form an opinion if they are using different approach, and this will give the auditor an advantage. Now let's continue now. So let's go to disadvantage now. One of the disadvantages of this business risk approach that the people that will carry out this risk-based approach, that means they will require. This risk-based approach require an experienced auditor. That means the people that will be part of the audit team that is going to carry out the audit using business risk approach must be experienced. They must be experienced. They must have a suitable experience. Because if they don't have suitable experience, because this will make you to think, what are the impact and all those things. That means carrying it with a junior audit staff may not be appropriate. So this is one of the advantages. And when you are using experienced team or experienced auditors to carry out this engagement, those that are experienced. That means the staff that you are using to carry out that engagement must be those that are very experienced and they have the adequate or suitable experience, because they must have an understanding of the business and its environment in which they operate now. So someone that just graduated and that just starts working in audit firm cannot have that suitable experience now. And that means if you are using this approach now, that means if you need experienced people to carry out this audit approach, what will happen? It will be very expensive. Now, also, if the auditor is trying to identify business risks now, that means we need to be working closely with the management of that organization. We need to be working closely with the employee of that organization to be able to identify the business risks. That means this may raise a question of independence. That means the auditor may be seen to lack of independence. Don't forget that we have independence in mind and independence in appearance. Are you getting what I'm saying? So this approach may raise the question of auditor's independence. Also, we say the approach is only suitable for what? It's only suitable for large companies. This is one of the disadvantages. It's only suitable for large companies. Am I communicating now? Now, when there is significant business risk, failure by the management to deal with the risk will affect the item in the financial statement. Am I communicating now? So, this approach, that means if there is any business risk and the management fails to deal with this risk, it will have an effect on the financial statements. Am I communicating? Now, this approach also says that this one of the disadvantages that weaknesses in internal control are a business risk which could be result in misstatements in the financial statement. This approach says that The audit problem are mainly what? Business related problem rather than internal control. That means if there is weaknesses in the internal control now, this approach will not make emphasis to that weaknesses in the internal control and what impact that the internal control system can have on the financial statement. So this is one of the disadvantages. So we have done disadvantage and advantage of business risk approach. So let's go to system-based approach. System-based approach. So I will explain this business-based approach. Now, when I started the possible business strategy, I told us that system-based approach is appropriate when there is effective internal control system put in place. If there is strong internal control system, that means system-based approach can be the suitable approach for the audit now. Now, what do you mean by system-based approach? This is an approach, this system approach is an approach that focuses on the internal control system of the client. And how effective is the internal control system? Am I communicating now? That means you can only use this system-based approach when the internal control system is adequate or effective. How do you know that the internal control system is adequate? Am I communicating? Now, for an internal control to be effective or adequate, that system must ensure that there is reliable financial information. That means, and if there are effective internal control that does not ensure reliable financial information is not effective or strong. That means effective and efficient of operation. Are they carrying the operation as specified or as specified by the management? Are we following the procedures? Are we following the rules? Are we following the order or the step that has been put in place for operation? Now, if the internal control system that has been put in place by the management, don't forget that it is the responsibility of the management to ensure there is effective or strong internal control system in place. So, for you to assess that there is effective internal control, there must be that internal control system must ensure reliable financial information and effective and efficient operation. Now, what about compliance with appropriate rules and regulations? That is one of the signs that the internal control system is effective. So, if the internal control system cannot ensure this thing reliably, that the financial reporting cannot be relied upon, that there is no effective and efficient of operation, there is no compliance with rules and regulations, that means there is weak internal control system in place now. Am I communicating? Because when you believe that the internal control system is effective, what happens? That means the control that has been put in place to ensure, am I communicating? The control that has been put in place to ensure that the transaction is properly recorded has been followed. That means if you are sure that control, because the internal control system has been put in place, will ensure that transactions that occur in that organization will be recorded appropriately. That means there will be there will be that means the auditor will not be forming a wrong opinion about the financial statement now. That means mostly the financial statement will be right to some extent. Am I communicating? Now we have looked at the nature of system-based approach. So let's look at what makes an effective system of internal control. make an internal control system to be effective? That's what I'm looking at. So don't press yourself. What makes an effective system of internal control? That means what can make an internal control system to be effective? Now we have 5 major things. We have the control environment, the entity risk assessment processes, the information system, the control activities, and the review and monitoring. So let's look at each of these components. That is international standard of audit 315 actually states 5 components that can make an internal control system to be effective. Now, because the auditor will need to look at the internal control system now, and for it to be assured that the internal control system is effective, all this has to be put in place. Am I communicating now? So let's go to the first aspect, the first component. What is it? We have 5 components. The first component is control environment. Control environment. Control environment. What do you mean by control environment? Control environment is the general attitude to internal control of management and employee in the organization. That means if the management have the attitude of ensuring effective internal control system, what will happen? That means they will be effective internal control system. That means if they don't have that attitude, they are not concerned about internal control in the organization. What happen? That means the financial statement will be prepared wrongly. Because the control that has been put in place, because they don't have the attitude of ensuring that the internal control system is in place. Because it is the control environment now, that is the attitude of the management and the employee of that organization towards internal control that would ensure that there is discipline and structure in place. Am I communicating now? Am I communicating? That means the control environment is the attitude of the management and the employee of the entity towards internal control. So if their attitude is poor, what happens? The internal control system will also be poor. But if the management, because the responsibility of internal control system is the responsibility of internal control system lies on the management. So it is the management that has the responsibility to ensure that there is effective internal control system. So if they don't have the attitude, what happens? That means there won't be effective internal control in place. And how do you know that there is attitude now? How do you know that there is control environment in place? How will you know that there is general attitude towards internal control? That means the elements of these are integrity. Their integrity. They give values. They give values. They value integrity and ethical values. Am I communicating? The management have philosophy for internal control. They take internal control serious. What are the organizational structure that has been put in place? What are the responsibility, assignment of responsibility and of authority and responsibility? That is what we are saying, that if an assessment is given to you now, you then pass the responsibility and ensure that you are responsible for that assignment that you have that you have performed. Just imagine someone is giving a responsibility now and you are not making the person to be accountable. That means that person can do anything they like. And that's why most of our organizations, especially in my organization, I know that. I mean, if you perform any transaction, any work that is being given to you, you are meant to sign and write your name on that list. so that we know that this thing is coming from you. So that if anything should happen, we know that we know who we are holding responsible. So, and the control environment now, the control environment will enable us to show that the organization has an high level of commitment. That means there will be strong control environment when the management can show that there is high level of commitment to establishing an effective or sound internal control system. So if they don't have an high commitment, if the management are not committed or they are not showing that there is high commitment to internal control, that means there is weak or poor control environment in place. So if these are in place, that means the management are all the auditor cannot rely on the internal controller. Let's go to the second component that international standard on audit 315 prescribed, and that is identifying and assessing the risk of material misstatement. So it says that the entity risk assessment process. The entity risk assessment process. Now, when we say the entity risk assessment process now, we are saying that as the management put in place, as they put a internal control system in place that will ensure that risks are identified, risks are assessed, risks are managed. Am I communicating now? So if the management have not put this in place, have not put risk assessment process in place, that means there will be what? There will be weak internal control system in place now. And I've told us that international standard on 315 says that for you to be able to identify the risks and assess the risks that the organization are exposed to, that you must have an understanding of the environment and of the entity and the environment in which that entity operates. So it's important because once the auditor does not have the knowledge about the environment, about the entity and the environment in which they operate, it will be difficult for the auditor to assess the entity risk process, whether it's strong, am I communicating? Whether it's strong or whether it's weak now. So let's go to the third now. That is information system. Information system. Am I communicating? So let's go to information system. Now, the information system consists, let's look at what makes up the information system. What makes up the information system is the structure. The structure that has been put in place. That means the physical and the hardware components. Maybe the organization, or maybe they are using paper to record or hardcover ledger notes to record their transaction. And if they are using what we call system, that will be the computer system they are using, will be the infrastructure. Am I communicating? Now, if they are using software now, also the information system comprises of the infrastructure. That means the physical and the hardware infrastructure. Am I communicating? The software, in some organization and they use software package. Those are the information system now. We have people, procedure, and data. Let me give an example now. Let's explain now. Now, information system is the one that generates that transaction. Am I coming? Information system is the system that you put in place to generate and to process transaction in an organization. Am I communicating? Now, that means the auditor is meant to have an understanding of the infrastructural system that has been put in place in that organization. What is the software are they using? Are they using manual? And if they are using manual, what are the manual procedures? What are the hardware or the physical component that are using to record that transaction? Who are the people that work on the system or that record the transaction? What are the procedures? What are the data that they are using to generate or to process transaction? These are what the auditors must put in place. Am I communicating? Or the auditor must understand about the information system. He said the aspect of the audit work will involve identifying and understanding, page 184. The aspect of the auditor work will involve identifying and understanding the following: the entity, principal, business transaction. What are the business transactions that the organization takes in place now? He said how these transactions are recorded in the financial statement. How do we capture it? These are what the auditor will look at, because the information system are the one that generates the transaction. They are the one that will record the transaction, and the method of processing those information, is it manual or electronic? Am I communicating? What are the procedures used in the preparation of the financial statement? These are what the information system will do. And the auditor is meant to have an understanding of all this now. So let's go to the control activity. Control activities is the internal control itself. Am I communicating? Internal activities are the procedures or practice used to ensure the entity or organization objectives are achieved. That means the control or the activities or the practice that the management has put in place to ensure that the objective of the organization is achieved. Am I communicating? Those are just imagine now that there's no time book in the organization, there's no clocking in of this thing now. Staff are working into the organization at any point in time. What will happen? That this will affect the organization to achieve their objective. That means if anyone want to collect anything now in the store, there's no record. Just collect whatever you want to collect in the. That means the organization will just overspending. That means they have not put a procedure in place. Am I communicating now? That means internal activities are those practice or procedure that has been put in place to ensure that the entity is able to achieve their objectives now. Am I communicating? Now, you may be asked in the exam that you should state the category of internal activities. The category of internal activities. Am I communicating? Now look at this now in page 186. It said under category of internal activities now. Then in the exam, if you are asked to suggest suitable internal control within a given system, the item in this list should produce a useful checklist. What they are saying is that you may be asked in your exam that you should suggest an internal activity or internal control that should be put in place now. A suitable internal control that they will put in place. That means they may give you a scenario and ask you that you provide an internal control system or activities in the exam. So they will not say you should suggest a suitable internal control now that should be put in place in that organization. That organization, that your internal control system that you want to suggest for that organization must actually produce this checklist that I want to look at now. It must produce the check. It must be in line with this checklist. It's not that you are stating the category of internal control. It's not that you are stating it. You will look at what is appropriate to them. What is appropriate to them must be in line with what we are looking at now. Authorization control. So one of the categories of internal activities or internal control is authorization control. Now, what do you mean by authorization control? That means for any transaction to be processed or for any transaction to be processed in any of the organization, it must be approved by the management. Am I communicating? Or the appropriate manager. Let me give an example now. In our organization, we have what we call invoice processing. In invoice processing, that's where you write the voucher, process the transaction, the check, and all those things before they will pass it to the treasury department. Those are the ones that will now go around the bank, drop the check or transfer of funds and all those things now. For them to write any voucher or write any check, those staff in invoice processing, they must see the approval of the director of finance. That means they will check the approval of the director of finance to process that transaction and check the approval of the chairman. That means the finance department, the finance director now, cannot process any transaction without the authorization of the chairman. Now, the invoice officer now cannot process any transaction with the authorization or approval of the director of finance or the accountant. Can you see now? So one of the category of internal control. One of the category is authorization control, and authorization control is saying that it's required that every transaction is approved by the appropriate manager or appropriate level of authority. What about physical control over the asset? 2 is physical control over the asset. That means when you say physical control over the asset, that means the control must ensure that there's a safeguard that will prevent unauthorized person from using the asset. Now, in our organization, each of the department or unit, they normally apportion a car and a driver to that department, especially the department that moves from one place to another. So we have a driver and a car or in-laws that will have been apportioned to that unit. That means someone else from another unit or from another department can't order the director, can't order the driver to just bring the car and be using it for his own personal use. Even though when you are going out, the driver normally record where they are, the location where they have visited, so that we will not be going full for just unnecessary use, something that does not related to the activity of the organization. Now people are not using it the way they like. I've seen in an organization where an official car is used to park block that is given to someone. The person is used to park block. Am I communicating now? There must be physical control over the asset now, so that this will prevent people authorized person from using it, and preventing authorized person from using that, it will prevent theft and damage. Just imagine a car. Now a car to a Toyota Camry, someone is using to back block. What will it cause? It will cause damage to the car. Now let's go to the third one. Arithmetic control. Arithmetic control means that all the transactions that there is arithmetic accuracy. That means once you have looked at it now, you wrote a transaction at 2,000, 1,000, 1,500. So everything should be at least 4,500. We now wrote what? 4,000. That means there is an arithmetic error now in this transaction, and which may have an impact on the financial statement. This means that if the category of internal control does not actually put arithmetic control in place, that's why you see that in an organization, like my organization now, when a transaction is being, when any transaction is being processed by the invoice, now we send it to the internal department. Internal department normally check, especially our payroll. They will add everything together. They will check everything, check the calculation allowance for each of those of the employee. They will calculate it to check there is arithmetic accuracy now, so that there won't be someone that is underpaid or overpaid, so that the transaction now that will be recorded in the financial statement will be correct, will be accurate. Now, accounting control, I'm in page 186, category of internal control activities now. Accounting control. Now, accounting control are control that ensure there is accuracy and completeness of record. Am I communicating now? There is accuracy and completeness of record. That means we need to calculate, we need to do reconciliation. Now, reconcile the bank statement with the with the account. Check the control account and check the individual account now. Like example now, you are aware of control account, control receivable account. Control receivable account is a summary of balance of receivable balance, right? Why? Let me say, if the company has said they are owing, that those customers that are owing them is 200,000, it will show in control account in 200,000. But control account will not give the breakdown of who are owing this 200,000 and the account of the individual that are owing this account, 200,000. Now, don't forget that accounting control means that there are procedures to ensure there is accuracy and completeness of record. That means our receivables may, if there is no control, and if there is no accounting control, that means our receivable may be more than 200 or maybe less than 200. And if this amount is reported in the financial statement, it will have an impact. That means we will be reporting some information that are not complete, because you are only this 200,000 only belongs to 3 individuals, and we have like 7 individuals that are owning the companies now. The second example is the use of control account reconciliation to check the accuracy of total trade receivables or total trade payables. That is, you need to check your control account, check the individual receivable account, and confirm and add it together and confirm whether it is the same thing as the amount in the control account. Now, what about management control? Is one of the category of management activities too. They said the management are the one that would what? That we apply the control. We ensure that there is control. He said these are control applied by management. Am I communicating now? They are applied by management. Include supervision by management of the work of subordinates, management review of performance, and control reporting. Now, let me give you an example. Now, management control will be that the management, these are control that is being applied by the management now. That means the person that is my supervisor now will be the one that will ensure that I'm following the internal control system that has been laid out, or that has been laid out by the management now. That means, like a director now, it is the chairman or the chief executive officer that will ensure that director is following the control mechanism that we put in place. That means control management now. Management control is that the supervisors that are being supervised. They are being supervised of the work that has been given to them by the appropriate level of management now. There are some organizations that the management does not, the supervisor does not bother whether they do anything or not. As far as he's doing his work, and as far as he is doing his own work, if you are not doing it, it does not concern him. These are control applied by management. They include supervision by management of the work of subordinates. Management review of performance. How do you management review? That is maybe the appraiser. Your appraiser is going to be done by your supervisor. So these are ways in which management apply control. What about segregation of duty? What we mean by segregation of duty is that one person should not start a transaction and end it or complete it. Look at it now. I'm the one that will approve the transaction. I'm the one that will write the check. I'm the one that will write the voucher. I'm the one that will take the money to the bank and the check to the bank. What happened? That means this may actually cause two things. That means if I make an error, there will be someone to actually detect that error. Because when job is being performed by two or more persons, wow, if an error will occur, that error will be easily be detected. That's why you have to have segregation of duty. One person should not be the one that will complete a work. I mean a transaction. That means if a particular individual wants to perform a fraud now, and it is not the only one that will be involved in that transaction, that means there is a likelihood that other person may suspect that individual wants to commit a fraud. So there should be segregation of duty, and I've explained. So category of internal activities or internal control, we have 5 categories. Authorization control, we have physical control over assets, arithmetic control, accounting control, management control, and segregation of duty. So let's go to the last one. Review. Now, the management has actually put the control mechanism in place. That means the control system. They have put that this is the practical and the procedure that must be followed. This must be the practice and the procedure that must be followed for any of the activities in the organization. But however, it is necessary for the management to review and monitor that control, because that control they have put in place may not be sufficient enough. That means they will need to strengthen the internal control system. That means there are some events or some circumstances that may arise that the control will not be able to detect, or the control will not be able to detect. So the management is required that they should review and monitor the internal control they have put in place to ensure that if there is inadequacy in that internal control, they can strengthen it. So they should review it on daily basis, on systematic basis now. So let's look at this now. So how will an auditor apply how will an auditor apply system-based approach now? These are summarized here. So this is it now. That audit approach could have been selected when at the planning stage. That means at the planning stage, the organization could have selected that this is the audit strategy that they want to use. Now the audit strategy now that they want to use now, the auditor will need to gain an understanding of the entity and its business environment. Now, now, in looking at it from his study and from what he has done so far, he observed that look at it now, if he has assessed that the internal control system is weak, he cannot use system-based approach. Am I communicating? That means if we discover that the internal control system is weak, system-based approach is not appropriate. That means what he use is intensive substantive testing. Intensive substantive testing, that is what you use. That's what the substantive testing approach, that's what you will use. In testing, that means every balance in the financial statement will be tested if the internal control is weak, because there will be an issue of arithmetic accuracy may be wrong, the accounting method of preparing it may be wrong, the standard that you are using to prepare may be wrong. So you need to test everything in the financial statement. So you will do an extensive substantive testing now. But if he discover that he has done his assessment and he has assessed that, maybe looking at the paperwork or looking at the organization and the historical background, you now discover that there is control, that the internal control is strong. Now, the auditor will not just start using system-based approach. That means he will not just rely on that internal control. He will not rely on the work of the internal control. What he will do is that he will do test of control to ensure that what he has assessed is correct about the internal control. That means if what he has assessed is good, he will now reduce the substantive testing that he will use. Rather than testing all the balance, he will test some areas in the financial statement. But if he discover that what he has assessed initially is not so about the internal control, he will go and do what? He will move to intensive excessive testing, substantive testing control. That's what we will base is you do substantive testing for all the balance in the financial statement. That means it's not all. Not it's not all. That means large amount of transactions in the financial statement will be tested. That's what we are doing by that's what we mean by excessive substantive testing. Not all. That is the majority of the balance. That is large amount of transaction that makes up the item in the financial statement will be tested. But if you discover that the internal control is strong, after he has done test of control, he will now reduce the substantive test. That means it will just be some area in the financial statement or that the internal control is not able to identify, or that the internal control is inadequate about that. That is where he will concentrate his audit on. So sorry, let me repeat what I said because I didn't on the camera when I received the call. So we have looked at least the three approach. We have looked at three approach, and the business risk approach is appropriate for large companies. The system-based approach is suitable when that means business risk approach is suitable for large companies. The system-based approach is suitable for companies that have effective or strong internal control system in place. And when you are building system-based approach, you are relying on the work of the internal control. The work that the internal control has done, that's why you rely on it. Look at it now. Now, that's why you reduce your substantive testing, because there are some work that the internal control has actually performed. So you rely on that so that what they have done is correct. So the order that maybe they didn't cover, that's when you now test. So it will reduce your substantive test before issuing out your audit report. Now, substantive testing approach now is focusing or concentrating on testing large number of transactions and account balance. And I've told us that it is time consuming. Because just imagine that you are testing almost or large or 90% of the transaction or the account balance that makes up the financial statement. You are testing it. All those accounts that make up it. Like my organization now, for the individual account that we have that make us to prepare our trial balance. I think our account, different individual account that we have, will be for different items in the financial statement. Should be more than, I think it should be more than 60. It should be more than 60. It should be more than 60, yeah. It should be more than 60. Because, like administrative expenses now, all those expenses we have for different ledger for different expenses now. So, based on the revenue code that we have, based on the expenditure code, we have different. So, we also have disability payable and all those things. So, it should be more than 70. Now, just imagine that you are not testing the transaction that is in the ledger of those 170 or let's say 65 accounts on monthly basis. The time consuming, and because the time consuming, the audit fee is always high when you are using substantive testing. That is costly for large firms because large firms now, just imagine Dangote we want to use substantive test approach for Dangote group of company. Just imagine, you know how many transactions they are into. How many transactions they are trying to daily or MTN. So now, and this substantive testing approach is you can use it, especially you can use substantive approach when the internal control system cannot, the internal control system cannot be relied upon. Now let's go to the last approach, which is statement of financial position approach. And I've told us that statement of financial performance and statement of financial position approach is actually appropriate or suitable for small companies. That means when you are auditing small companies now, this approach is suitable for them. This approach focuses on all the balance in the statement of financial position. That means it only focuses on all the balance in the financial statement. That means all the balance means the opening balance and the closing balance. Because this approach believes that if the closing and the opening balance is correct, that means the profit in the statement of profit or loss account or other comprehensive income will also be correct. Am I communicating? That means, you know, the small companies, because it is small companies, like let's say all these small hotels, all these small businesses, bakery, and all those small organizations. You can use statement of financial position approach. Just test all their balance in the financial, and you know that the balance, their balance in the financial statement may not actually be much. You get what I'm saying? So you just test it. He said this approach believes that if the opening balance and the closing balance are correct, then the profit for the year may also be correct. So look at it now. And the approach is appropriate to small companies. Now, this is the principle or the theory behind this approach. He says that the accounting equation, and this approach, it is based on the following accounting equation. That is, opening net asset plus profit for the year equals to closing net asset. So if you are able to test that your opening net asset, and what's your opening net asset? That is your asset minus your liability. That means if you have tested your opening balance and your closing balance of your net asset, probably, if you have tested and shown that it's correct, that means your profit for the year will be correct. So we have come to the end of this chapter, which is the audit approach. The audit approach. So let me